This morning's ISM manufacturing report just detonated the mother of all reality checks. U.S. factories are now contracting at the fastest pace in 4 months. New orders, they're in free fall, and that's just the tip of the iceberg. You're about to discover that this is a global issue that's going to put millions of workers on the unemployment line, hammer retirement counts, and plunge the world straight into the next recession. Plus, tonight's show is brought to you by Super League. You can find them on the NASDAQ and the symbol SLE. And they're a powerhouse in playable media that's just secured major funding to supercharge its digital asset push and launch exciting new initiatives in early 2026. And get this, the stock's been firing on all cylinders, now closing over its 10-day volume profile for 3 straight days, flashing a super bullish signal that could spark an epic 28% rally. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now stay with me because I'm going to show you exactly how bad this gets and what you need to do before it's too late. Now let's just put the numbers right on the table. The November ISM manufacturing PMI printed 48.2. That's contraction, a hard contraction, and a miss of every forecast. But look, it gets a whole lot worse. New orders collapsed to the lowest level since the post-COVID chaos. Production and employment indices both in deep red, and yet prices paid jumped again. Factory gate prices are seeing the highest cost pressures now in months. Now, I really want you to understand what's going on out there. Imagine you own a small to mid-sized supplier. Your phone stops ringing because demand is plunging. Orders, they're getting canceled, ones that were placed 6 months ago. The problem is you already bought the raw materials at tariff-inflated prices, and now you're stuck holding inventory you can't move, and your next move is going to be lay people off before the holidays just to survive. And this isn't hypothetical. It's what's happening in the manufacturing sector right now. And what that means is roughly 30 million Americans whose jobs are directly or indirectly tied to manufacturing are going to start seeing their hours cut, bonuses vanish, and then their jobs are going to completely disappear. What we're seeing right now and experiencing is a stagflation squeeze in real life. And here's the worst part. It happens right before each and every recession. Now let's dive into the details because this is getting worse by the minute. And I want you to understand this is the 9th straight month of manufacturing contraction, and that's the longest streak since the Volcker era. And every time we see a streak this long, a full-blown recession happens within 12 months. No exceptions. Now, let's dive into the sub-indices because this is where it turns from bad to brutal. New orders collapsed to 47.4. That's the 3rd straight month of contraction and the lowest print since post-COVID chaos. That's future activity. So what you're seeing here is when new orders are this weak, production and jobs roll over 6 to 9 months later. What we're doing here is teeing up an absolute disaster for hiring in the next year. In fact, we're likely to see a surge in layoffs. And here's the proof of this chart of manufacturers at new orders and durable goods in blue. It's the unemployment rate in red. And you can see the lag in what's about to hit 30 million U.S. workers who are, again, employed directly or indirectly in the manufacturing sector. Worst part, it started 10 months ago. Hours were already getting cut and then jobs. So we're right in that window. In a couple more months, watch, the layoffs, they're going to surge. And here's one of the big reasons why, because backlogs of orders, it fell to 44. That's the 38th straight month of decline. Again, 38 straight months. And that means the existing work that's been keeping factories afloat, it's almost gone. So when new orders and backlogs are this weak, production and employment don't just slow, they grind to a halt, fall off a cliff. And again, we're right within that window where the layoffs surge. And the proof is in this chart. Let's take a look at manufacturers at new orders of durable goods, still in blue, now against industrial production in red. And you can see what's coming early next year. Industrial production, you can clearly see that red line. It's going to plunge, and this is not good. Because what this means for workers is at best they're going to get fewer hours, but for many, they're not even going to have a job. And here's the evidence. The employment index now dropped to 44, and that is a sharp contraction. What we're seeing is the average manufacturing work week in the payroll report has been declining for 10 straight months. That means paychecks are shrinking. And this is a leading indicator because hours worked, they get cut before the pink slips fly. Let's take a look at this chart of average weekly hours of production of non-supervisory employees in blue against the unemployment rate in red. There you can clearly see. First, it's hours ago, and after a big enough drop, then the labor market follows. And if you think this is going to improve next year, not a chance. Let me show you why it's going to get worse, a whole lot worse. Because the S&P Global's final November read showed that the steepest rise in warehouse stocks in the survey's 18-and-a-half-year history. So what we're seeing here is manufacturers front-loaded everything ahead of the January tariff wall. And then demand, it collapsed at a faster rate than anyone thought was possible. And as you know, I've been warning about this for months, that if we build up inventory and we don't move it, that the payback period is going to be severe. So the issue here is they built the inventory. They took on the debt to build it. They hired, they put on extra shifts, and now new orders are vanishing while costs, they're already locked in at tariff-inflated prices. So what we're seeing for a lot of small and mid-sized businesses is their margins are getting squeezed. The first thing that goes is overtime, then hours, then raises, then jobs. As far as consumers go, well, I know they're tired of higher prices, but the reality is at some point, these businesses are going to be forced to push these along because their pressures, well, it continues to rise. Prices paid spiked again to 58.5. That's now the 38th consecutive month. And keep in mind, and this is happening while activity collapses. And this is what you call stagflation. What happens is you get rising prices into weak demand. And next thing you know, margins get squeezed and then the unemployment rate heads higher. And this leads every recession throughout history. The problem is we're not alone. It's synchronized. It's a global issue. Let's turn to Canada as we head to the S&P Global Canada Manufacturing PMI. It came in at 48.4. It's the 10th straight month of contraction. So you notice this trend here. And what happened in Canada? New orders, they're down. Employment, down. And the backlogs, get this, they dropped at the sharpest rate since July. The reason they blame? Well, it had to do with tariffs. But let's turn to the UK, where we find out that S&P Global noted that the PMI there rose to a 14-month high of 50.2, but it was solely on the back of large firms. What happened underneath? Job cuts. They continued for 13 straight months. And the backlogs? They dropped at the fastest rate since April. Let's pull down to the broad Eurozone, where we see the manufacturing PMI fell to 49.6, indicating renewed deterioration in factory conditions. So what happened there? New orders, they were positive, but now they flipped negative. And job losses, they're accelerating to the fastest rate since April. But not to be outdone, we turn to Germany, whose manufacturing sector has been in a bad position for a long time. Their PMI dropped to a 9-month low of 48.2. New orders, they dropped by the most since January. Export sales dropped for the 4th month in a row and at the fastest rate this year. Backlogs, not to be outdone, they fell at the fastest rate since June. And of course, as you can imagine, more jobs were lost. So what we're seeing right now is the entire world's factories are dying at the same time. U.S. exporters are getting crushed, the dollar's likely to rip higher, and emerging markets, they're going to get obliterated. There's no external demand to save us. We're all in the same boat. And here's the one that traps the Fed and breaks the soft landing fantasy for good. We now have the widest divergence between the ISM and the S&P Global US PMIs since the global financial crisis. The ISM is screaming recession at 48.2. The S&P, they're saying expansion at 52.2. And here's the thing. This gap is never resolved bullishly, never to the upside. But the markets, they're pricing that in. They're saying, look at the rosy survey data. Forget the ISM, they're wrong. And that complacency is going to get punished and hard. Because as we know, the Fed really wants to cut rates to save jobs. But the problem is, and you just saw this in the surveys, every tariff-driven price spike is keeping inflation expectations alive. And at some point, these manufacturers, they're going to have to push those prices down. So while the market is pricing in a cut in December, don't be surprised if the Fed stays on hold. In fact, S&P, they're pricing in 6 cuts and 12% earnings growth next year. The data, what we just saw, makes both of those mathematically impossible. Now, if you think stocks are immune to what's coming, not a chance. Industrials, materials, small caps, discretionary, all those sectors are walking right into a wood chipper. And the broad indices, well, they're coming down too. And here's the proof in this next chart of manufacturers' new orders of durable goods, that's shown in blue, against the NASDAQ 100 in red. And you can clearly see every time new orders head down, what happens? The market follows. The problem is right now, new orders are headed back down. The market is headed up. And again, just like with the PMIs, it never resolves bullishly. So what we're facing here is in the midst of stagflation, we're going to get a collapse in new orders. It's going to take the industrial base with it. And that means a massive bear market in the months to come. And keep in mind, when the market does eventually go, it's the moment the entire soft landing narrative breaks. So here's the truth. We're sliding into a stagflationary hard landing the Fed swore could never happen again. but you're not powerless. Here's your playbook right now. I want you to lock in any borrowing costs. Think mortgages, cars, business loans before the long end explodes. And if you think that's not likely to happen, based on what we're seeing right now with JGBs, this is a real concern that we could see a spike in the long end. You want to build 3 to 6 months in cash and do it as fast as possible because manufacturing labs, when they hit, it's like lightning. You want to rotate to defensive. Think staples, utilities, gold, short-term treasuries, because right now the cyclical trade, as you can see, it's over. And remember the bond king, Jeffrey Gundlach, he said hold 20% of your portfolio in cash. And now you can see why. It's to buy the diffs. You may even want to consider being long the dollar as an option. And keep in mind, the next pay report is the tripwire, but it's not due this Friday. It's being delayed until December 16th. And I want you to keep an eye on this report because if manufacturing hours and temporary help roll over, and I predict that they will, this recession calls goes from probable to undeniable overnight. So if you take these steps now, you won't just survive the deflationary storm, you're going to come out wealthier and more successful than ever before. Now let's dive into Super League. Again, you can find them on the NASDAQ under the symbol SLE because they're the go-to company that's revolutionizing how big brands connect with gamers. They're all about creating fun, interactive ads and gamified content inside massive worlds like Roblox and Minecraft. And with over 160 million active players in the network, they're helping brands like yours truly stand out and build real loyalty. Now check this out. Their sales have exploded from just over $2 million in 2020 to a whopping $25 million in 2023. And they're not stopping there. Super League is on a clear path to profitability this year, driven by bigger deals and longer-lasting brand programs. And they just nailed a massive $3.8 million win. That's the biggest ever. And talk about a comeback. In late October, Super League got the green light from the NASDAQ, regaining full compliance and keeping their shares trading strong under SLE. No more worries means they're rock solid and ready to charge ahead without any distractions. And here's a game changer. They wrapped up a huge financing round backed by Evo Fund, pulling in up to $20 million. And this wiped out nearly all of their debt, beefed up their balance sheet with about $15 million in fresh capital, and set them up for explosive growth. It's the end of a 6-month turnaround that's got them primed and pumped for the future. And now they're accelerating the digital assets big time. They're hunting for a top expert to join their board and teaming up with partners for a Q1 2026 launch. Imagine integrating cool digital assets into their platform, creating even more engaging experiences for brands and creators. And CEO Matt Edelman said it best. He said this move aligns perfectly with their mission to deliver value-driven fun. Now, with their tech powering measurable results across mobile, web, and immersive platforms, Super League is redefining brand connections in today's attention-grabbing world. They served nearly 100 brands last year, racking up over 500 million visits to their experience. That's a massive reach. Now, let's check out this chart setup. And here you can see that red line, that's the 10-day volume profile. And over the last 3 days, buyers have stepped in big, putting a floor in. Now, let's take a look at the potential here. See that other line? That's the 30-day volume profile to the upside, setting up a potential 28% return. Again, everything you need to know in the pinned comment and description below. Because looking ahead as 3D web booms, Super League's proprietary tools, analytics, and creator network position them as leaders in this space. They're building the operating system for immersive engagement, and with the debt gone and funding in hand, the opportunities are endless. Again, keep an eye on Super League. You can find them on the NASDAQ under the symbol SLE, because with Super League, the sky's the limit. And as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades and use your risk control levels when you do. And with that, I'm Steve Metre. Thanks for watching. Thanks for being fans. Bye now.